Ever wondered how some people seem to do everything right with their money, but still hit a wall? Today, we're diving into 2 mistakes that can quietly wreck your financial future, even if you think you're on the right track. If you're ready to unlock the secrets to not just growing your wealth, but protecting it, stick around. And hey, if you're new here, don't forget to subscribe and hit that notification bell so you never miss out on our insights. Imagine someone who started investing just like many of us. They contribute regularly, they've read the books, and they've watched their account grow. They feel like they have a handle on things, but what if I told you there are hidden traps that even smart investors fall into? These aren't the simple mistakes we all learn about at the beginning. These are the kinds of mistakes that show up after you've built up enough wealth to have something serious to lose. I'm talking about huge tax missteps that can erase a massive chunk of your hard-earned gains, and a dangerous focus on one single investment that can turn a success story into a sad story overnight. This story doesn't have to be yours. Today we're diving into these 2 big mistakes I see successful people make all the time. More importantly, we're going to talk about the exact ways you can protect yourself. Let's talk about the #1 silent killer of your investment returns: not having a good tax plan. We all know we have to pay taxes, but a lot of people just see it as something to deal with in April. That's a huge mistake. Think of it like trying to fill a bucket with a big hole in the bottom. That hole is taxes, and it's the biggest, most predictable drain on your money over the long run. Remember, it's not just about what you make, it's about what you keep. This goes way beyond just paying taxes on your profits. Let's talk about the common ways investors get this wrong. First, people often hold the right investments in the wrong accounts. It's like keeping your ice cream in the pantry instead of the freezer. For example, they'll hold something like corporate bonds, which generate a lot of taxable income every year, in a regular brokerage account. Every year, that creates a tax bill that just chips away at your growth. A much smarter way is to put those kinds of investments inside your 401k or a traditional IRA. Inside that tax shelter, they can grow without you getting a tax bill every single year. On the flip side, investments like growth stocks that you plan to hold for a very long time are often a better fit for your regular brokerage account. Just thinking about asset location like this can save you thousands over time. Another strategy that so many people miss is tax loss harvesting. Think about it like this. It's one of the few good things that can come from a down market. You sell an investment that has lost value. That loss can then be used to cancel out gains from your other investments, which lowers your tax bill. And if you have more losses than gains, you can use up to $3,000 of it to lower your regular income tax. It's a way to turn a negative into a real financial positive, but many investors just let those losses sit there. The second big problem is not having tax diversification. Everyone talks about diversifying your investments, but what about diversifying your tax situations? To build real, lasting wealth, you want to have money in 3 different buckets. Tax-deferred, like a 401k, tax-free, like a Roth IRA, and taxable, your brokerage account. Why does this matter so much? Imagine you're retired and you need $100,000 for the year. If all your money is in a 401k, that entire $100,000 is taxed as income? Ouch. But if you have money in all 3 buckets, you can pull a little from each to create the tax bill you want. This kind of control is a superpower in retirement, but you have to plan for it. The third tax disaster is the ticking time bomb of estate taxes. A famous and very sad example is what happened to the estate of actor James Gandolfini. Because of poor planning, his family ended up paying over $30 million in taxes. Many people think this is just a problem for the super rich, but as your investments grow, it can become a problem for more families than you think. A good plan makes sure your money goes to your family with the smallest possible tax bite. Finally, let's talk about something I see all the time with people who work at big companies: restricted stock units, or RSUs. They get these shares and think of it as free stock. What they don't realize is that as soon as those shares vest, they are taxed as regular income, just like your salary. If a lot of shares vest at once, it can push you into a much higher tax bracket and create a huge, shocking tax bill. Your employer will withhold some for taxes, but often not enough. Without a plan, you can get hit with a massive tax bill you weren't ready for. So how do you fix this? Start thinking about taxes as part of your strategy. Put the right assets in the right accounts, build up your 3 tax buckets over time, and if you get RSUs or have a growing estate, talk to a professional to make a plan. By the way, if you're finding this video helpful and want more topics like this, comment the word investing down below so I know. Now let's talk about the second portfolio killer, over-concentration. In simple terms, it's putting too many of your eggs in one basket. But what's so tricky about this mistake is that for a while, it usually looks like you're a genius. Imagine this. You work for a great company and your employee stock is flying high. Or maybe you bought a tech stock years ago and now it makes up a huge part of your portfolio. You feel smart, you feel successful, and you feel rich. But what you're really doing is sitting on a financial time bomb. The most common way this happens is having way too much money in a single stock. As a general rule, you really shouldn't have more than 10–20% of your total investments in any one company. I personally think even 5–10% is a smarter limit. It's not rare for me to see people with 30%, 40%, or even 50% of their entire net worth in one stock. They'll say, "But it's a great company." And they might be right. But even the best companies can run into trouble. A new competitor, a change in technology, a new regulation. Things can change fast. A company that looks unstoppable today might be struggling tomorrow. It feels great on the way up, but it can wipe out years of hard work on the way down. A really dangerous version of this is the employee stock trap. I've seen this happen, and it's devastating. Think about it. Your salary, your bonus, and now most of your life savings are all tied to how well one single company is doing. If that company gets into trouble, you could lose your job and see your savings disappear at the exact same time. It's a double hit. Your loyalty to your company is great, but from a financial standpoint, it's incredibly risky. So what's the answer? A smart, disciplined plan for diversification and rebalancing. First, you have to know your numbers. Take an honest look at all your accounts and figure out what percentage of your money is in any single stock. If it's over that 10–20% range, you need a plan. The solution is to slowly and carefully sell some of that stock over time. You don't have to sell it all tomorrow. That could create a huge tax bill. Instead, you create a systematic plan to sell a certain amount each quarter or each year. For employees, it's about changing your mindset from owner to investor. As soon as you can, you should have a plan to turn those company shares into a diversified portfolio that isn't tied to your job. I know it can be hard to sell a stock that's been so good to you, but smart risk management is what separates investors who are successful for the long run from those who just get lucky for a little while. So there you have it, 2 major investing mistakes that can wreck your financial future. Mismanaging your taxes, which slowly eats away at your wealth, and over-concentration, which puts you at risk for a sudden, big loss. What's interesting is that both of these are often problems of success. You don't worry about big capital gains taxes until you have big gains. You can't be over-concentrated in a stock until it's done really, really well. That's what makes them so sneaky. But remember, the key here isn't to be afraid, it's to be empowered. Knowing about these traps is the first step to avoiding them. Building wealth is one skill, protecting it for the long haul is another. It means you have to be proactive with your taxes and disciplined about diversification, even when it feels hard. Mastering these principles is how you can win. You need to stay grounded and take it all in. By doing that, you're building a fortress around your financial future, making sure the money you work so hard to build is there for you and your family for years to come. By the way, I'm building a Google Sheets command center, something simple but powerful. It's designed to help you track your net worth, investments, income, cash flow, spending habits, and even your compounding progress, all in one place. It's not just a tracker, it's a strategy hub. The kind of thing I wish someone had handed me 10 years ago. If enough people want it, I'll launch it soon. And there'll be an exclusive launch discount for early supporters. You can join the early access waitlist with the link below. The tool will cost less than one bad financial decision, and that's the point. Now, I want to hear from you. What's the biggest investing lesson you've ever learned, or maybe a mistake you've seen a friend or family member make? Sharing these stories helps our entire community learn and grow. Drop your experience in the comments section below. Remember, this video is for educational purposes only and is not financial advice. Always do your own research and speak with a qualified financial professional before making investment decisions. If you found this breakdown helpful, I highly recommend watching my next video. It connects directly to what we've covered today and will help you take the next step toward financial freedom. Don't forget to subscribe so you never miss the tools, strategies, and stories that can change the way you think about money. Thanks for watching, and I'll see you in the next video.